Loss aversion, feeling the pain of losing twice as much as the joy of gaining. Fear can lead to paralysis or selling investments prematurely to avoid potential losses. Greed can tempt investors to chase risky opportunities or hold on to losing stocks for too long. Overconfidence bias, believing you have more knowledge or skill than you do, leading to excessive risk or poor choices. Regret aversion, dislike of making a wrong decision, potentially leading to inaction or missed opportunities. Euphoria/overexcitement, feeling overly optimistic after a winning streak, potentially leading to risky behavior. Disposition effect, selling winning investments too soon and holding on to losing ones too long. Anchoring bias, relying too heavily on the first piece of information when making a decision. Can be emotional or cognitive depending on the source of the anchor. Confirmation bias, seeking information that confirms your existing beliefs and ignoring contradictory evidence. Information bias, making decisions based on readily available information, even if irrelevant or incomplete. Familiarity bias, favoring investments you're familiar with, limiting diversification and potentially hindering returns. Hindsight bias, believing an event was predictable after it happens, leading to self-blame or overconfidence in future predictions. Herding bias, following the crowd and investing in popular options, regardless of suitability, potentially leading to bubbles and crashes. Status quo bias, preferring the current situation and avoiding changes, even if not ideal, hindering taking advantage of new opportunities. Mental accounting bias, categorizing money into mental buckets, potentially leading to different investment decisions for windfalls versus regular savings. Recency bias, placing stronger emphasis on recent events, potentially leading to overreacting to short-term market fluctuations. Neglect of probability, completely disregarding probability when making decisions under uncertainty, leading to overlooking risk or potential outcomes. Representativeness heuristic, judging the likelihood of an event based on how similar it is to another event, potentially leading to misinterpretations. Self-attribution bias, taking credit for successful investments while blaming external factors for losses, inflating confidence and leading to riskier behavior. Illusion of control bias, believing you have more influence over outcomes than you do, leading to overtrading or impulsive decisions. Sunk cost fallacy, continuing to invest in a losing proposition because of past investment, ignoring the potential for better returns elsewhere. Belief bias, letting your personal beliefs cloud your judgment and influence investment decisions. Pessimism bias, having a negative outlook, potentially leading to underestimating potential returns or missing out on opportunities. Optimism bias, having an overly positive outlook, potentially leading to underestimating risk or making overly aggressive investments. Conservatism bias, placing too much weight on past information and resisting updating beliefs based on new evidence. Framing bias, making decisions based on how information is presented, potentially leading to suboptimal choices. House money bias, feeling less risk-averse with profits from prior investments, potentially leading to reckless behavior. Denial bias, refusing to accept negative information or losses, potentially delaying corrective actions. Projection bias, assuming others share your own biases and risk tolerance, leading to misinterpreting market behavior. Ambiguity aversion, dislike of uncertainty, potentially leading to avoiding potentially good investments due to lack of complete information. Social proof bias, relying on the actions of others to make decisions, similar to herding bias but with a stronger emphasis on social influence. Competition bias, feeling a need to outperform others, potentially leading to excessive risk-taking or neglecting diversification.